Groupon is still losing money. In its first earnings report as a public company, Groupon says it brought in $507 million in the fourth quarter, up almost 200% year over year. But the daily deals giant lost $42 million overall. Shares are getting pummeled in after hours. CEO Andrew Mason has had some grumpy and even glib run-ins with the press since the IPO, including with me.
How do you feel? You must feel good. Say something. Anything? What about Groupon's long-term future?
But Mason did shed his dry sense of humor and got more serious when he spoke to analysts and investors today. He does have a big job ahead to convince them that daily deals aren't just a fad. Take a listen to what he had to say.
Just as technology has changed the way we communicate, do business, and buy retail goods, we're about to see what technology can do for local commerce. Groupon, with its unparalleled foundation of consumer and merchant relationships, will drive that change.
Still, rival Living Social has postponed its IPO and recently posted a $558 million loss. But Groupon is pushing forward now with 10,000 employees and new acquisitions. Now, let's head out to our editor-at-large, Cory Johnson, who's been combing through all the numbers. Cory, what trends are you seeing? And more importantly, you were saying there are some numbers Groupon isn't telling us.
Yeah, a really interesting first ever quarterly filing from these guys in a quarterly conference call. You mentioned the humor, snarkiness of Andrew Mason. Far be it from me to criticize someone for snarkiness, but there's a little bit of that at the end of the conference call where he talked about how much fun he had. Can't wait to do it again. But I want to focus down on just a couple of things with these numbers. You mentioned the revenues. You mentioned the lack of profits, the losses, and the expanding losses. Let's talk about billings. That's the gross revenue number these guys put up. Their billings growth is falling real fast. Why is it falling fast? Well, it could be their marketing costs. You know, when these guys first filed for their IPO, we saw their marketing costs. And if you look at their marketing costs for every quarter, after the first filing for the IPO, they took the foot off the gas. They let the marketing costs fall a little bit, although, again, $156 million in the course of 14 weeks ain't nothing. But it was a 14-week quarter for the fourth quarter. But if you look at the percentage of marketing spend as a percentage of revenue, they spent a lot less, although they spent a little more last quarter as a percentage of revenues. But the results were disappointing. They did not add a lot of customers. In fact, the number of customers that they added was just 3.5 million customers in the quarter. So if you look at how much they spent in that marketing, again, that $156 million, they spent $156 million just to get 3.5 million new customers. That's $44.76 per customer added, which is of great concern since they only get about $15 in revenues from a customer, let alone profits. And I also want to mention, you made reference to this, but the things that they didn't tell us were really shocking. Most importantly, the subscriber number. These guys went to the mat with the SEC saying our subscriber number is really important, even though it's just a list of email addresses, and even though those email addresses might not even work. They didn't even tell us what the subscriber number was. Featured merchants, a very highly featured number throughout their IPO process. They don't even tell us what the featured merchants are. Whether those will come out when they finally file their annual report or that shows us both the annual and quarterly numbers for the company, who knows? But we don't have a lot of comps for this company. Their first ever quarter, they're already dropping metrics that they told us were so relevant. So the health of Groupon doesn't look great, and we don't really know the progress of their business. Emily?
Certainly a very intriguing first report from a newly public company. Cory, stand by. I want to bring in Sam Hamadeh, CEO of the financial analysis firm PrivCo. Sam, you've said there are signs of a massive slowdown here. Traffic is falling off a cliff. What signs in particular are you looking at? What do you think is the most important number that we got today?
Boy, hi Emily. There are a few very, very key numbers. First, as Cory said, what they didn't tell us, they're now no longer reporting a couple of key metrics. And, you know, most of your viewers will know anytime a company stops reporting a very key operating metric, it's not a good sign. I guarantee you if the numbers had looked good, they would have reported this. So let's look at a couple of those. First of all, we have total subscriber counts, as Cory said, no longer now reported at all. That also means it makes it a little harder to calculate that revenue per subscriber. As we know, we look at that chart, that's dropped from over $5 per month per subscriber 2 years ago. It was $4 a year ago, and then gradually it's just fallen off the cliff all year. We're now down to barely over $1 according to PrivCo estimates for Q4 2011. It's probably going to be measured in pennies from the first quarter next year, not dollars. So to me, that revenue per subscriber is the most important number. They made it harder to calculate now. Never, never a good sign.
Cory, how unusual is it for a company to stop reporting a metric that they had been reporting before?
Yeah, I'm a glass half empty kind of guy. I mean, I'm maybe the wrong person to ask. I've seen a lot of companies do it, but to Sam's point, the companies that do this, if they want to show you a good number, they'll show you a good number. If the number starts to look bad, they'll tell you that number didn't matter. What you have here very clearly is Groupon made a case to the SEC. The SEC, we didn't know about this at the time. We saw the changes in the filing. What we didn't know was that the SEC was privately sending letters to Groupon saying, what's with this subscriber number? Well, an SEC person went to your website to look at it and had to enter an email address. Does this make us a subscriber when we were just curious? And Groupon was forced to admit that the number included people who didn't mean to be subscribers or didn't want to use this service, or maybe the email addresses were no good, but they still defended the use of that number. So for them to step away from it without explanation is really remarkable, I think. And it says that they're still trying to figure out what the right metrics are for their business at the same time that the market's putting a really high multiple saying this is going to be successful for a real long time. That's a disconnect.
To that point, and to be fair to Groupon, this is, of course, a very new business. Sam, we've seen huge losses coming from Living Social. That's got to make Groupon look far better by comparison. Even if the daily deals market is a new market and a difficult market, Groupon is certainly winning that market, right?
Well, no, honestly, Emily, I disagree. And here's a couple of reasons why. First of all, Groupon had been told by their underwriters they had to manage to show a fourth quarter profit. It can be a small profit, but they absolutely had to hit that. The consensus estimate for the fourth quarter Groupon profit was 2 to 3 cents a share of net income. They couldn't even meet that. And remember what we're talking about. When we say consensus estimates, this company had 14 underwriters on that IPO. All of them initiated coverage. All of them gave them basically a softball target that they could easily hit, and they couldn't even hit that. They showed a loss for the quarter, so not good.
Cory, what's the conclusion here? Is the conclusion that Groupon in particular isn't doing well, or that the daily deals business just isn't a good business?
I ran into an infamous short seller at the airport a few weeks ago, and he said, people keep saying that Groupon doesn't have a moat, doesn't have a sustainable competitive advantage. They've got a great competitive advantage. They can lose a lot more money than all the other money losers in the space. Facebook got out of this business, Yelp got out of this business because they couldn't make any money in this business, not because they wanted to give it up to Groupon. And to Sam's point about the way that they couldn't turn a profit and the estimates from all the other underwriters, Groupon had a very small float when they went public. Underwriters have a great vested interest to be friendly with Groupon because Groupon's going to have to do some kind of secondary to get these giant chunks of stock held by both their venture investors and employees that want to sell stock. So you would have thought the number that was on the analysts' estimates would have been a very friendly one and a beatable one. So I'm not much for analyst beats as we know, but I think that it is telling here that they couldn't get to that number.
Sam, last question. Cory mentioned insiders and employees who we assume that there are a lot of them that are going to want to sell their shares when the lockup expires. How could that impact things? Could that cause more trouble for Groupon?
Well, there's no question that they're going to want to, again, try to manage for the short term to their next milestone, of course, is when that lockup expires later this spring. And, they're going to have to show growth beginning again in order to have that stock rise high enough for people to be able to all start selling at a profit. But there's no question when everybody's selling all at once, it's just going to hit that stock price.
Well, certainly we are going to continue to watch this company very closely. Sam Hamadeh, CEO of PrivCo, and our own editor-at-large, Cory Johnson, thanks so much for this conversation.